Welcome to this quick overview of the Upstream Oil and Gas Financial Planning Model. The Upstream Oil and Gas Financial Planning Model enables quick deployment of full financial planning driven by considerations that are key to the upstream oil and gas industry. This dynamic solution enables on-the-fly integrated what-if analysis by quickly updating key drivers in order to see how changes would impact the full financial picture from the bottom line to cash flow. I will first go over a high-level view of the inner workings of this model. The revenue forecast is created by data input through the sales price and differential price module, as well as the volume input module. Data input into the drilling and completions CapEx input module for the capital expenditures. In order to assist in the income statement creation, we have financial statement driver inputs, which consists of the interest expense, depletion and depreciation, general and administrative, and leasing operating expense modules. The revenue forecast and capital expenditure portion go through a time shift process in order to accurately account for production prepones and postpones. The adjusted revenue forecast will flow into the income statement along with all financial statement driver inputs in order to populate the income statement accordingly. Finally, adjusted capital expenditures and income statement information flow into the cash flow in order to show in and out cash movement. Jumping into the Anaplan, we start off in the pricing dashboard where we input the sales price of each resource type, which in this case, we're using oil NYMEX, Henry Hub, which is gas, and liquid. Below that, we enter the differential pricing of each resource type according to the region. The final adjusted pricing will be calculated in the chart below. Moving on to the volume input dashboard, this is where we input the forecasted volume for each resource for each region. Within the drilling and completions CapEx input dashboard, we input the capital expenditures incurred for the particular well. If delays or even pull forwards in the schedule are forecasted, then you can go to the time shift dashboard and make expected start date changes by well, region, and even by the rig that was scheduled to drill the particular well. This in turn makes adjustments to the production volume in order for the revenue to be accurately reflected in the P&L. The final forecasted volume would be displayed in the adjusted volume dashboard, with both the time shift and risk factor applied to it. This is also the dashboard where you can input the risk factor for each region. Finally, the revenue is calculated by the forecasted pricing and adjusted volume for all regions, with the capability of drilling down to the region or well level. If you are curious to see how much revenue is being lost by delaying certain productions, the time shift variance dashboard will show you a view of the variance of the original forecast against the forecast with the time shift applied to it. After all inputs, time shifts, and adjustments have been made, the P&L will be populated to view for analysis. So this should give you a high-level overview of what Anaplan can do for the upstream oil and gas financial planning. For more information, visit us at www.akili.com. Thank you for your time, and I hope you enjoyed this overview.